Hello and welcome. I'm Benoit Paliquet. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the first quarter of 2025 review. And even though we're recording this in mid-April, we're going to cover the end of March, but also obviously bleed into the activities and the events of early April. Let's start with our usual table. This third column, you will find a TSX that did a decent return, coming in at 1.5%. But you will find at the end of the quarter, we had negative performance for the first part of the first third of the year in the S&P 500 and in the NASDAQ, obviously led downwards by the technology stocks. We had Europe doing decently, well, actually, we should say really well, with 10% in the first quarter. Emerging markets, which is half China, 2.5%. No change in the Canadian dollar. Bonds did okay at 2%. No change in oil price. The downward revision really happened after quarter end. Gold prices had a spectacular quarter, up 19%, following up or tacking on to or adding up to a 1 year performance of 37% and a 3 year performance of 25% year on year. If we go back to and go look at the 3 year column, which is the one I prefer to sort of focus on, we're still at 7.8%. We are trending back to mean. These numbers are coming down as opposed to the end of 2024, and emerging markets and Europe are moving up. The bond market still 2.5%. Still, the rates are slightly higher than they were 3 years ago. So basically, we're coming in with basically a coupon return, whatever the index or the interest income is. That's what you're getting in terms of total performance. Gold, as I said, went up tremendously in the past 3 years, really on fire in the past year. In terms of interest rates, where they're settling, if you are loaning out money to the Canadian government for 1 year, you're just under 2.5%. For 5 years, you're at 3.7, and if you go out 10 years, you're actually earning a little less. If you want to go the GIC route, 5 years are around 3.5, 1 year are 3.2. If you were to summarize the quarter, it's really just mean reversion. Europe and Canada were lagging in 2024, and the S&P and NASDAQ were on top. It's now reversed. Now that you're up to date, you can stop it here. It's all you need to know for what happened in the past quarter. We're going to do a short or a deep dive or not so deep dive into the markets. And then at the end of the video, I'm going to go into sort of more elaborate data, if you will. So let's get started. So we'll start where we ended 2024, which is really a study of the Mag 7. The Mag 7 is really the Magnificent Seven, which is Apple, Alphabet, Microsoft, Tesla, Amazon, Meta, and Nvidia. Can I say that any faster? Anyway, from the peak of 2021, they've really dominated, I would say, coming out of COVID, the COVID lows. These seven stocks really dominated the indices, so they had a tremendous influence, so much so that they make up 35-40% of the S&P 500. And so, however they go is how the index will go in terms of the S&P 500. So we had coming out of COVID, obviously a bounce back. 2021, they propelled forward. They peaked really at the end of 2021 and came down 43%. Pretty big move down, which is a technical term for retracement. For some reason, that's what we use. It doesn't feel as bad. Again, we bottomed more or less at the end of 2022. Gained it back more or less in 23, and then 24 is really when the propulsion happened. So from this peak forward, the markets came up at 58%. So a lot of volatility, and if you look at from peak to trough, you're at 6.7%. Again, if you're expecting markets to give you 6, 7, 8%, we're on trend here. It's just there's a lot of volatility to get you to trend. Since the end of the quarter, obviously markets have given up or accelerated their givebacks in terms of negative performance. For many investors, the difference is, when do we head for the hills? When are we staring at an earthquake? And when are we just looking at a tremor? So that's really what we're going to focus on this part of the video. Now the question is, what's the difference? Is it the score on the Richter scale? The difference between an earthquake and a tremor? The answer is no, it's actually duration. In investing, a long, protracted bear market is what we want to avoid. So we've been through them, 2000, we basically had a sideways NARMIC for 13 years. We had ups and downs. We had 08, 09. So basically you had a long protracted time where basically you're making no money and a lot of times you're losing money. Um, so how do you tell the difference? And that's what we're going to focus on. One of the first indicators that we look at in terms of trying to figure out if the market downdraft or sell-off is a tremor or an earthquake is we want to look at the credit markets, and we want to specifically look at consumer credits. So the chart you have in front of you is called the US delinquency rate for credit cards for 90 days and over. And what we're looking for is, this is what bad credit looks like. This is what a tough economy looks like. This is what helicopter money from the government looks like, where a lot of people coming out of 2020 were getting money from the government. So obviously the delinquency rates were coming down. What we're seeing now is back on trend, going back to, say, 2014. So this, in isolation, this marker does not scream earthquake, it screams tremor. It actually screams no change. Let's look at the bond market. So we have the yield of the US Treasury going back to 2010. And then I'm focusing on this little window. If you can see, basically, this is the end of the quarter right here. So there was a lot of conversations around, oh my God, um, uh, yields are dropping and then yields are spiking. So a lot of times you have to take these headlines with a grain of salt. So let's take a step back here and have some perspective. What you can see is this is 2020 with the yields coming down dramatically, central banks getting involved. But you can see now this is the latest rate as of the recording, or this chart is April 10th. So you can see that we're in this, what we call a box, anywhere between 3.4 and nearly 5%. That's normal volatility. And if you go all the way back to 2010, it's kind of more or less where we were 15 years ago. And so the headlines are screaming spiking, but really when you take a step back, there's really no um, earthquake here in terms of the bond market. So we've looked at consumer credit, we've looked at government credit. Now let's look at the bond market, but the lower credits, the lower credit quality. So the chart that you see here is the triple B tranche, if you will. So credit markets are rated, double A, or sorry, triple A, double A, single A, and then it falls into the B. So this is the triple B market, which is just on the cusp of the lower tier of investment grade. What you can see here is, again, this is what panic looks like in terms of credit markets. This was a scare in credit markets. But on average, most investors in this type of credit are looking to make or earn about 3 to 5%. So these are basis points, about 3 to 5% above whatever the government bonds are paying. Again, did we see a spike? Absolutely, but we were coming off a pretty darn low level. So again, this is not an earthquake. This says tremor. Obviously, this chart can change, and we obviously monitor it so we can make changes upon it. But at the moment, the market sell-off appears to be, based on all the markers, the three I've shown you, and there's more to come later in this video. This is really just a tremor. So we've looked at credit, then we're going to look at equity markets and the option markets, which tend to amplify the movement. So what you see here is the VIX index, which is a volatility, the up and down movement. So on average of the past 30 days of the S&P 500. So it's a metric like any other metric. So again, we're looking for spikes. So this is 2020. This is 08, 09. And the marker that we're really looking for is sustained numbers above 50. They will spike sometimes above 40. We had in 2011, we've had in 2015. And it's a normal, obviously, market downdrafts. But this is, again, based on the option market. We are not looking at an earthquake here. We are still looking at a tremor level of sell-off. Finally, we're going to look at the last markers. There's many, but I think I've shown you enough charts here. So what you're going to see here, down here on the left, is called the CRB, or Commodity Research Bureau, and it's an aggregate of commodities. So you'll have oil in there, but you'll have industrial commodities, medical commodities, agriculture commodities, and so on. It's an aggregate. So basically what you want to see is you see this spike coming out of COVID, and whenever you have a sell-off, you tend to see commodity price fall off. It's normal. Big recession, less demand, and then you get a sell-off. There will be some sort of normal volatility in terms of the prices, but you can see coming out of so going down into the recession, and then what happens is commodities invariably always spike out of a recession. Right? Because commodity producers curtail their production, and then when the economy fires up again, there's a spike in prices. That's entirely normal, and then as higher prices tend to attract more production, and then the prices kind of fall off. That's a normal cycle, and then again you get a recession, curtail production, spike in prices, and then we're coming off. The ultimate level, you'll notice that these are not dollar adjusted. So a lot of these common commodity prices have more or less been in the same neighborhood going back many, many years. Here we have is the oil price going back to 2007. Again, we have this sort of the market crash, 07, 08, and then commodity price again, recession, producers produce less, and then as the economy takes off again, there's less product in the market, prices will spike, and then so on and so forth. The cycle goes. This is again 2020. We had sort of a weird single 3-day negative price that has to do with how futures contracts work, but basically we bottomed out here at the real bottom was, let's call it $15. So again, we had this spike for the same reasons, and now we're back at this box here of $60. We closed at $70, but going back in time, you can see that if you go back to the left, you hit $60 or $70, you hit the price a lot of times. So again, based on these commodities, we're not looking at an earthquake at the moment. We are looking at a tremor. Well, the next logical question is how common are these tremors, these downdrafts that we all hate? So the first market we're going to look at is the S&P 500, and we're going back quite a ways here. We're going back 15 years. So the question is, since 2010, how many times has the market in Canada fallen more than 10%? They're all outlined here. I'll save you you can hit pause if you want, but basically 17 times, roughly once a year, a little bit over once a year. Next question is, well, how often have they fallen 15% or more? The answer is 6 times. So market volatility is very common. However, there are times it's really odd. There's some years where you get no volatility. So usually off a bounce back, say 12 to 18 months, you don't get a volatility, and then there's a give back. So you can see a lot of volatility, move up. So a lot of volatility, sideways movement, finally one move down, move up again. So volatility is normal, and does not always lead to sell-offs. You can see a 10% downdraft and then a big push forward. So a lot of market participants will say, well, whenever the volatility spikes in the investment world, I want to head for the sidelines. It's not true. Here's another sort of 10%, 12% downdraft and then a big push forward. So that marker of increased volatility followed by market downdrafts doesn't hold. Let's look at the same study but for the S&P 500. Again, how many times has the S&P 500 fallen 10% or more since 2010? The answer is 15 times. So again, kind of once a year. There are periods where it's more frequent, and there are other times where you go 2 or 3 years without a market downdraft. That's entirely normal. So we've had basically since 2020 or 2022, I should say, we haven't had a big market downdraft. So we had a small 10% one, which is in 23, and then we have to go back to 2022 for these big market downdrafts. So as of the peak, as of the time of this chart, which is April 10th, um, we really had we're down about 17%, and since then the market has bounced back. So again, volatility is normal and it's part and parcel of investing. So how do we use these tremors to our advantage? Well, there's a playbook for that. First thing you do, the concept is sell and upgrade. So whenever you're in a period of time where nothing goes on sale and you're deploying capital, a lot of times you'll deploy capital in companies either that you will hide into, so high dividend paying stocks, not a lot of growth profile to them, but not a lot of volatility. You'll tend to do that at the end of a cycle, and that's okay. It's where you want to be. So very often we'll refer to those as laggards, or maybe they're stocks you had an investment thesis and the investment thesis just hasn't worked out. Um, what we'll then do is sell and upgrade. So you'll want to sell what during a tremor, everything's on sale. So you want to sort of lean into the usually expensive, what we call generals, the market leaders. So you don't, again, not necessarily want to go overboard with those, but you might want to get exposure to one or two of those market leaders that are usually expensive. The other thing that, and that's the hardest part, you have to be open to selling your most expensive names, the best performing names, the ones that have gone from $37 to $150. Those types of names, you have to be open to selling them or at least trimming them. And that's really hard to do. Why? Well, if your stock is selling at a valuation that is just perfect, there's no such thing as perfection when it comes to business. And so invariably, at some point, it's going to disappoint. So you have to be open to sell your winners and then move them to some of the stocks that are selling off. But take your time. Markets don't turn in a V. They tend to sort of um, fall, then rise again, then fall again, and they're sort of what's called a bottoming process. Bottoming process. Think of it as a bouncing ball falling off a table. It does come down, hits the floor, comes up again, and sort of settles down after a while. And so that's really what we're looking for is taking our time and while we're upgrading your portfolio. That's it for data. We just wanted to sort of review our mandated exponent, and the mandate is really to be boring, especially in these times. We aspire to be boring. We want a really solid, good portfolio, but rarely are we chasing the stars. So why? Because we're chasing this tension, this tension between your growth in capital, the security of your capital, and then generating consistent return and consistent growth of the capital. And so that's the tension that that we're managing at all times. That's it for the sort of more longer video. And then for those of you who want to stay on, you can certainly watch. We have more data for you as we move forward. As always, if you have any questions or feedback, we'd love to hear from you. So let's look at what hasn't changed. In other words, how do we look past this fog? Because very often in a snowstorm, you're sort of focusing on the storm and forgetting what's behind. All storms pass. So let's review what is immutable, dividend focused, and dividend can be share buybacks as well. But really, we're focusing on income, quality balance sheets, proven management, global approach, valuation discipline. Again, we've mentioned that all the time. Um, Not necessarily picking the bottom, but getting a reasonable price on our purchase and a reasonable sale price. Stay away from headlines. Some adjustments we had to make. We definitely are in a deglobalization sort of cycle, and that always leads to higher prices or inflation. Um, the higher that bleeds into consumer discretionary income in terms of because of higher prices, higher inflation, and there's definitely a migration and an impact on housing prices. And then the K recovery. So the top shelf, if you will, of socioeconomically are doing quite well. There's more and more of them, but also the lower leg of the K is also growing, unfortunately, quite faster than the top leg. And government policies, they always have an impact, if not immediately, but they sort of set the standard for where spending will go. And we want to sort of be active and sort of, unfortunately, the more volatile the markets, the more we have to respond to that and have sort of a more active, be more reactive to the markets, if you will. So let's move to the market data part of the video. The upper right is the top performers in the past quarter for the S&P 500. So what's interesting is a bit of a mix. You have sort of companies that are somewhat laggards or defensive names like utilities, telecom, and CVS, which has been a retailer that really has been struggling for a long time, finally putting a very strong fourth quarter or first quarter, I should say, performance. And then some sort of consistent performers that never tend to make this list, but because there's not a lot of positive names, they tend to show up. So something like Welltower or Gallagher um, are good performers, or Philip Morris International. They're consistent performers, but they tend to not sort of make the top 10 or top 15. In terms of the bottom performers, well, what's interesting is we have some fallen stars, if you will, in terms of Tesla, Moderna. So a lot of these names that used to be top performers, United Airlines coming out 2022, in 2020, and Delta, Broadcom, these are some of the top performers, and obviously mean reversion reared its ugly head. I will say that it's a fairly broad, diversified set of names, both on the laggards and the top performers, and that's a sign of health. In Canada, the top performers, well, the Canadian market really was driven by gold. So it follows that top performers would be, a lot of them would be in the mining sector. On the laggard side of things, again, some ex all-stars of for certain portfolio managers, but again, a fairly diversified set of names. And so some of them ex-stars with sort of a mean reversion effect to them. Others, um, companies that are or had difficult quarters or are going through difficult headwinds at the moment. Can't really draw any conclusions from this list. If we move on to the sectors of the S&P 500, what's interesting is we pulled in a negative sort of return for the fourth quarter, but only two sectors were negatives. And the reason is those are the most heavy, or the heaviest weight in the S&P 500, technology and discretionary. And so a lot of portfolios are probably positive or slightly negative, doing a lot better than the S&P 500. And the reason is underneath, it's sort of a flip side of what happened in 2024, where 2024, you had to be in technology to turn in any sort of performance. In 2025, in the first quarter, technology and discretionary, which were the rockets of 2024, were actually the ones that hurt your performance. So again, a bit of mean reversion. That's the theme of the first quarter. In Canada, it's our economy is not doing so well. So outside of energy and obviously mining, not a whole lot going on. A couple of names, consumer staples, that's really driven by one or two names. Utilities did okay, but again, most of the markets are kind of not doing so great. So it's interesting that even though we put in a sort of 1.5% positive return, we did it despite a lot of negative sectors. So if your portfolio's not quite sort of there, a lot of it has to do because of sector, your sector exposure, if you will. We're going to look at the market sort of fundamentals real quick. So on the left is the Canadian market. So the purple line is the earnings per share. So what you look at is you look at the index and you see how what kind of earnings has the index been earning. And basically you can see that it's kind of been in a box. There's no real upward trend line to the Canadian market, largely because when, you know, right now, what's going very well is the gold sector and the mining sector. They're doing very well, but then energy is not doing well. So basically, the because our portfolio or our index is not that broadly diversified, it is very much dependent on certain sectors doing well. And right now, there's not a whole lot going on in Canada. The PE ratio is what investors are willing to pay for each dollar of earnings. So view it as, when they get exuberant, they'll pay a high um, metric. Um, but when they're not enthused with your market, they will pay a lot less. So that right now we're looking at an investor class, if you will, that's not that enthused with the Canadian market. The dividends are doing okay though, largely on the back of utilities and financials. If we move to the S&P 500, the purple line is trending upwards. Obviously, we're coming out of 2020, but there's still a pretty solid upward trajectory to the market in terms of earnings. What we are seeing though is the P ratio is sort of fading. It's kind of mid-level to its range, 28 being very expensive, sub sub 20 being very cheap. And then the dividend line is going up. So again, what's the conclusion of this? In Canada, the earnings are lethargic. In the US, the earnings are growing, but they are at a slower pace. But investors are um, reining in their exuberance and paying a little less than they used to in terms of what they were willing to do in 2021 in terms of earnings growth. So here's a bit of an esoteric concept, which is volatility in time. So on the left here, I'm showing you the Royal Bank stock charts, and all the little D's here are the dividend payments. You can see that obviously will coming in consistently at the end of every quarter. So if you look from basically exactly 20 years ago, the stock has gone up 316% or 7%, almost 7.5% per year. That doesn't include the dividend that is just price appreciation. So you can add another 3.5% on an annual basis in terms of dividend return. The concept though is you got to live through these really tough periods of both, you know, soul crushing volatility to the downside, and then a bounce back, but really a flat line. So if you bought in 2007 and you're looking at your statement in 2011, well, you're at the same level. You made dividends. That's it. And then there to boot a give back, and then there's a push forward. And that is, I'm picking Royal Bank, which is known in pretty much in every portfolio, most people's portfolio. But the concept here is volatility of a quality stock is normal. Can't get away from it. So if you want this 7% per year on an annualized basis, you really have to live with this downside volatility. As portfolio managers, when things get over exuberant, investors get over exuberant, we will trim, maybe we'll sell completely, move to something else. But the point here is, at the end of the day, quality stocks, there's a misnomer when things are good, obviously when the market rips like this, that all these stocks don't go down. They do go down, they go down a lot, they still pay their dividends, but over time, quality does matter. So how do you get through this volatility and really the more time. So another way to look at it, how do you get through volatility? Well, if you have short-term thinking or you're only worried about next month, next week in terms of your portfolio, it's going to compress your ability to go through or limit your ability to go through volatility because you're not thinking about these long 20-year periods. Ben, you'll say, well, you know what? Ben, I'm 65 years old. I don't have 20 years. Fair enough. So how do you extend that when you're older? Well, a lot of it has to do with planning. So the planning around your cash flows, maybe your expenses. A lot of it has to do with if you've mapped out your financial life and you own quality assets, it's a lot easier to stay disciplined. But if you stay short term in terms of thinking, even if you think that you actually can outfox the market, which is another sort of mistake many investors make, um, and you don't want to put the work around the planning and the cash flow and forego quality assets, then it's really tough to have discipline. That's it for this quarter's 20 or first quarter of 2025 review. Thank you for watching.